The management of finance is not going to be covered in your assessment when you get back to school. However, we're going to make a start on it so that we don't lose any ground. The first presentation for management of finance is all about the role of the finance department and sources of finance. So the learning intentions there are to be able to understand the role and the duties of the finance department in an organisation, to distinguish between internal and external finance, and to look at and discuss the different sources of finance available to different types of organisation. So what's really important here is that you're able to determine, for example, for your case study, what the type of organisation is, so that you're able to discuss different types of finance that would be suitable for that particular organisation. So the first slide here is about the role of the finance department. So the finance department quite clearly deals with everything financial, everything to do with money in the organisation. So some of the things they could do here: ensuring funds are available to allow an organisation to achieve its objectives. So this might be, for example, they might decide that it's time to find an alternative source of finance, it's time to release some new shares, or whatever it happens to be, so that the organisation has enough money to achieve its objectives. They also ensure costs are monitored and controlled. So costs clearly can't get out of control, so it's their job to make sure that costs are staying within a certain level. For example, wage costs, etc., might be getting a little bit too high. That's clearly going to have an impact on profit, so it's important that they look at things like that. Ensure that there's adequate cash flow. Cash flow is the money running in and out of the business. Businesses have to have cash available to be able to function, and that's something that we're going to talk about later on, because we're going to talk about the difference between profit and cash, and that's quite important. We're going to do that in the next presentation. They also have to make sure that they try to maximise their profits and keep their profit levels high, and that's going to be appealing for the shareholders, because remember, shareholders are going to get a share of the profits in the form of dividends. So they want to see an organisation that's making good profits so that they're getting their dividends. And to generate appropriate financial information, it's the job of the finance department. If the organisation, for example, is a limited company, then records have to be kept, accounts have to be made up. But this is important for any kind of organisation, that financial information is available for anybody who wants to see it. So here are some of the functions. These are more kind of broken up, if you like, things that they would actually do in the finance department. So maintaining financial records we spoke about, paying wages and salaries. So yes, the HR department are going to be available to decide where you sit on the scale. So how much are you going to be paid when they offer you a new job? However, it's the job of the finance department to make sure that those salaries and those wages are actually paid. And remember, back under HR, we talked about the difference between wages and salaries. Wages tend to be paid on a weekly basis, salaries on a monthly basis. The third point there then, the payment of bills and expenses to trade payables. Now that's a word that you'll not be familiar with just now, but I'm just going to talk about that. So paying bills and paying expenses. So for example, if you buy goods from a supplier and you don't pay the supplier just now, you're going to pay the supplier later on, then that person becomes a trade payable. This was originally a term we called creditors, and a creditor is someone that you owe money to. And trade payables have just now, that's the new term that we use for people, for these creditors, for people that you owe money to. Preparing budgets, it's really important that an organisation budgets just as families do. They have to budget every month to make sure that they've got enough money to see them through the month. It's the very same thing with an organisation, and that's the topic we're going to look at next. Gathering information to prepare annual accounts. There's quite a lot involved in that. So organisations have to bookkeep, they have to keep records of the incomings and outgoings in the organisation, the buying of assets, the selling of assets, the expenses, etc., the incomes. So that's all really important to gather that information to prepare these annual accounts. And they've also got to analyse that accounting information. So they've got to take the accounting information and perhaps compare it with last year or compare it with a competitor to see how the business is doing in relation to previous years or in relation to competitors. And that's something else we're going to look at later on. So this next slide here, this next slide is starting looking at the sources of finance, and there are a variety of sources of finance that organisations can use in order to function or to expand. So businesses source finance from different places, and where they get it from will depend on a number of factors. So these factors would be the size of the business. That's going to very much depend on where you can source money from and how much money you can get. The sector of business they operate in, that's the sector of the economy, that's just the same thing. Is it the voluntary or the third sector? Is it the public sector, or is it the private sector? Why the finance is needed. It's like someone going to the bank for a bank loan. The bank will want to know why you want the bank loan. Money's just not handed out, so why the finance is needed. And that's also going to determine how much you need as well, and for how long it will be required. So these are some of the things you have to take into account when you're looking for sources of finance as a business. This was one of the learning intentions, internal via external finance, and it's pretty much self-explanatory here. Internal finance is money that the business has generated from within the business itself. So for example, the main way of doing that is through retained profits. And that would be, you made profit last year and you've carried it forward to this year, and you can use that money, if you like, in the organisation. External finance is money that the business gets from outside the business, and this is where we're going to spend the majority of our presentation here, because most of the finance that a business receives is external, and it can be short-term, medium-term or long-term finance, and that really depends on the length of time it takes to pay back. So let's have a wee quick look then at internal sources of finance. These are retained profits, and these are profits that are kept back from previous years, and they're used to generate more profit in the future. So what happens here is organisations will, if they make a profit at the end of the year, some of that profit will be shared out among the shareholders in the form of dividends, and some will be kept and reinvested in the business, and that's the money that the business can use to carry out activities, anything it wants to do. With this method, there's no interest to pay back. So you're not having to worry about paying interest on money that's been borrowed, because it's your money. However, it's a very slow method of growth, because the company would just be relying all the time on retained profits. So that can be a bit of a problem. Another internal source of finance would be selling assets. If businesses have non-current assets, things like machinery, vehicles, parts of their premises, etc., that they no longer use, then they could sell these items to raise finance. It's a good way of raising finance, and it's also a good way of getting rid of assets that you no longer use. You can sell them and make some money from them. But what you could do is, if you need that asset in another form, you're going to have to rent it or lease it, which is something we're going to talk about in a minute, if required, and that can be a bit expensive. So it really has to be selling assets that you no longer need. We're now moving on to external sources of finance, and what I've said here is these can either be short-term, medium-term or long-term sources of finance. So we're going to start off with the short-term sources of finance, and these are the ones that organisations are going to pay back within a short period of time. And the first one's a bank overdraft, and obviously people like ourselves can have bank overdrafts as well. And what it really means is you're withdrawing more money out of the bank than you've actually got available in your account. And banks allow you to do this. If you set up a current account with the bank, they will normally give you an overdraft limit, which means that that's the amount of money they will allow you to take out of your account over and above what's there, what you've actually got. It's really simple to arrange an overdraft, which is one of the advantages of it. You just have to give the bank a call and they'll arrange that for you. And the interest is calculated on a daily rate on the amount overdrawn. So what it means is you're not paying, if you're going to pay it back really quickly, then you'll find that you're not going to pay very much interest. It can be a problem paying interest on a daily rate, because it can be quite expensive as well. But it's good from the point of view, if you're not going to need the overdraft for any length of time, it's going to be calculated on a daily basis. However, it can be expensive if you're borrowing money for a long period of time, as I've said there. So that's why overdrafts really are a short-term method of finance. The next one is trade credit, and trade credit is where you're buying products, supplies, assets from someone and you pay them back at a later date. So this is purchasing items from a supplier where the goods are received immediately and paid for at a later date. You're basically buying on credit, and we call that trade credit. The longer the terms, the better the company's cash flow position. Now, what we mean by terms is the length of time that they're allowing you to pay this back. However, what you'll normally find is if you take something on credit, the organisation you're buying from will not normally give you a discount for prompt payment because you've not paid. So you'll lose any discounts for prompt payment, and really you're relying on your supplier to give you good terms. So obviously you're looking for someone who's going to give you a longer time to pay back, because what that means is you're then buying the goods or buying the raw materials, changing them into finished goods and selling them before you actually have to pay back the money to the supplier of the raw materials. So it's a great idea if you're trying to turn your money around quickly. Another short-term source of finance is something called debt factoring. And debt factoring is used by organisations if they have money that's due to them. So we've got the opposite situation here where we've got these people called trade receivables or debtors. Debtors are people who owe you money, and we call them trade receivables, nowadays. If you have a number of people who owe you money, then it can be time consuming for you to chase that money up. It could also be people who are not paying quickly enough and you're having to keep getting in touch with them to pay the money back. So what you can do to save yourself time is you can sell off these debts to a debt factoring company, a debt management company. And what they'll do is they will then buy the debt from you, I have to say at a cheaper price, and they will then chase it up so that you don't have to do that. So it's called debt factoring, and it's where you sell different invoices or money that people owe you. You sell them on to a debt management company. They will obviously pay less for them because they've got to get something out of this. And you then don't have to worry about chasing up these debts. It saves the company time and money chasing up debts, which is a great idea. However, the business doesn't receive the full amount of the outstanding debt. Debt management companies have to get something back for chasing up the debt on your behalf, really. So you'll find that you'll have to sell these debts at a cheaper price. So for example, if someone owes you £1,000, then you might want to sell that off to the debt management company for £985. So the debt management company are making money out of it by actually having to chase the debt up. Here's a video link on debt factoring, which will maybe make it a little bit clearer. It's a little YouTube video, so feel free to watch that and it might make it a little bit clearer to you. Another short-term source of finance, which can be quite unusual for a profit-making, a private sector organisation, is crowdfunding. And it's a way of raising finance by asking a large number of people for a small amount of money. Now, crowdfunding is normally used in charity-type situations, but it can be used for private sector organisations. It tends to be done over the internet, and the people who donate the money don't receive the money back. It's basically a donation. Some entrepreneurs, some businesses might use incentives to try and get people to do this. So it might be that they might give them some form of discount for the business so that they are encouraged to more or less donate money to the business. Not very commonly used in private sector organisation, but it is an option. Now moving on to medium-term sources of finance. Now these tend to be paid over a period of months, paid back over a period of months, or up to a year or whatever. You can get short-term bank loans, and bank loans are where you're borrowing money for the bank for a specific purpose paid over a period of time. Now you have to have a purpose, you have to have a reason for wanting to pay off to borrow the money from the bank, and the bank will ask you what the money's for. It's paid back over a period of time. Now with a short-term loan, if you like, I know it's a medium-term source of finance, it's a little bit confusing. It's normally paid over a year or a couple of years or whatever. The good thing about bank loans is it makes it easier to budget, as the loan is repaid in a number of fixed instalments. So you will if it's over a year, then the repayments will be split over the 12 months, and you'll maybe pay back every month. You will pay a fixed amount of money, so you know for budgeting purposes how much you're paying back. However, the thing about bank loans is you're paying interest, and very much depending on the kind of deal you get from the bank, interest rates can be high. Another medium-term source of finance is something called hire purchase. And hire purchase is where you buy something over a period of time. You're paying for it in instalments. You'll be paying interest on it again, but you don't own the item until the very last payment. So for example, if an organisation buys a piece of machinery on hire purchase, they will be paying the machine back over a period of fixed instalments, and only when they have paid the last payment to that machine do they actually own it. So they're more or less hiring it up until the last payment. If they renege, if they don't pay their payments, then the organisation who sold it to them is well within their rights to come back to them and take the machine off them, because it doesn't belong to them. So the deposit is paid for an item and the rest is paid for in instalments. The company doesn't own the item until the last payment is made. A good thing about it, why would you do this, is the cost is spread over a period of time, which makes it something more affordable. You might not otherwise have been able to pay for it. But once again, interest rates can be high. You will pay interest back on hire purchase. You might get a deal that is a 0% deal that customers get, but consumers get, but you'll tend to find that interest is paid. Another medium-term source of finance then is leasing, and leasing is where you never own the item. Organisations that give their employees company cars will tend to go to a leasing company and they will lease cars for their staff. Buying cars is a crazy way to lose, a big way of losing large amounts of money very quickly, as cars depreciate in value, cars and vans. So what organisations tend to do nowadays is they tend to lease the cars for their employees. And what it means is they're just renting them for a period of time. Now, what's really good about leasing is every 2 or 3 years, you'll tend to find that the product, whether it's a machine, whether it's a piece of equipment or a car or a van, will be upgraded. And you just keep paying the payments all the time. So all you're doing is renting, more or less renting the vehicle or the equipment for a period of time. So it allows the company to have up-to-date equipment or vans or cars, because as I say, it gets updated every 2 or 3 years. However, it can be expensive and the company never owns the item, so it's not an asset to them. You can't call it an asset, it doesn't belong to you. All you're doing is paying an expense every month for the vehicles or the machinery or the equipment that you actually rent or hire. Another medium-term source of finance then is a grant, and the grants are money received from the government or the EU or any kind of enterprise agencies for a specific purpose. The great thing about a grant is you never have to pay it back. Grants are never repaid. It's money given to you. However, it tends to be tied into a project and the business should be undertaking. There's a lot of paperwork to fill out for a grant as well, and you'll find that it's only normally given once. It'll be very, very difficult for businesses to keep getting grants. During this current pandemic, the government are giving grants to organisations to help them, because they're obviously not getting business just now. And that's maybe a kind of different situation, but they have to qualify, they have to fit into certain categories and characteristics and things to be able to get that grant. So grants are great because they're not repaid, but it can sometimes be quite difficult to get a grant. Now we're moving on to long-term sources of finance, and these tend to be paid over much longer periods of time, okay? Anything from over 3 years onwards, but I mean, some of them can be very long. In this particular instance here, we're talking about mortgages, and mortgages are loans, special types of loans that you use to purchase a property or land. So consumers will have mortgages to buy houses. You tend to find they're taken over periods of about 25 years. It can be more nowadays. It tends to take to be repaid because it's such a large amount of money to repay. So that's the great thing. You're paying it over a very, very long period of time. Interest rates are not fixed. You tend to find that interest rates will move around. You can get fixed rate mortgages for periods of time, but if the interest rate in the country goes up, then you will end up paying more for your mortgage repayments. If it goes down, then obviously the opposite happens. You will have to have a deposit. You can't just take 100% mortgage. You'll have to have something to put towards the purchase of the property or land, which can be quite a lot of money, okay? And the mortgage will be secured against your property. Now, what that means is if you renege on your payments, if you don't pay your mortgage, then the mortgage provider, which is normally a bank, will then they will then repossess because the property, because it actually belongs to them. They've purchased the property and you're paying the mortgage back to them. So these are some issues with mortgages. Another long-term source of finance is share issue, and share issue is where the organisation sells shares, which are small parts of the organisation. Owners of shares are known as shareholders, and these shares, if you're a public limited company, are sold on the stock exchange, on the London Stock Exchange. If you are a private limited company, remember, the shares are sold among family and friends, so they're not sold in the stock exchange. What's great about shares is you can potentially raise large amounts of equity, and the shareholders benefit from this thing called limited liability, which we know about from the very start of the course, where the shareholders will only lose what they put into the business. The admin costs involved in selling shares, it can be quite high. There's a lot having to go on there, and share prices do fluctuate. PLCs are also only authorised to sell a certain number of shares. You can't just keep selling shares all the time. That's not fair to shareholders because they're obviously getting a share of the profit, and the more shares there are, then the profit becomes more diluted. So it's not very fair for shareholders if you keep selling shares. It doesn't make your shares, people want to buy your shares because they'll see that there are a large number of them, and the chances of getting a reasonable amount of dividend would be quite slim. So PLCs are authorised to sell a certain number of shares. Debentures then here are one you might not have heard of. If organisations have sold their authorised number of shares and they need some other form of finance, then debentures tend to be paid back over about 10 years. It can be 15, round and about that length of time. And these are loans received from private individuals or other organisations. So what happens is the organisation can sell debentures, which is where people like ourselves can buy these debentures. And what happens is you are paid every single year. You will be paid debenture interest. You will be paid interest on the loan that you give to the company. The debenture is the loan. So you will be paid interest irrespective of whether the organisation makes a profit or not. Debenture interest is an expense to organisations. It's like loan interest. They have to pay it back. So you will be paid over the period that you hold the debenture, whether it's a 10-year debenture or a 15-year debenture or whatever, you will be paid interest for that every year. Debentures are normally things like 10% debentures, which means you'll get 10% interest on your debenture every year. What happens at the end of the period is you will get your money back. These debentures will be redeemed, which means you will receive the value, the original value of your loan, of your debenture at the end of the period. So you will get paid interest throughout the time for actually giving the money over, and at the end of the period you will receive the original value of your debenture back. Large amounts of equity or capital can be raised through debentures. However, debenture interest has to be paid for by businesses even though they make a loss, and that's the big problem for businesses because it's just an added expense for them. However, they can raise large amounts of equity. The last slide here is about venture capital, and venture capital is where organisations are maybe embarking on a risky venture, and banks might say, no, we don't like the venture, we think it's far too risky, we're not prepared to lend you the money. So organisations can go to venture capitalists, who are organisations who may be prepared to lend the money for this risky venture. However, what you'll normally find is you'll find that the interest rates can be higher because of the risk involved. So businesses with maybe a risky credit rating can secure finance from a reputable source. So that's if you maybe don't have a great credit rating, you will still be able to receive a loan from a venture capitalist. Venture capitalists can either charge you large amounts of interest, excuse me, or they might choose to ask for a share of your business, which can be, you're having to give up part of your business. Thank you very much.